Hi there. If I had to look at this market right now from scratch, knowing what I know about how these rallies behave, how traders get trapped, and how late-stage momentum can make smart people look silly, I would approach this week very differently. Most people think the big question is whether the move has gone too far. I don't think that's the right question anymore. I think the right question is much simpler. Where does this thing pause? And when it does, who's ready to buy it? Today in New York, it is Sunday, April 19th. And before we go any further, comment the day and date you're watching from. If you get value from these videos, subscribe and comment John A.G. Best so I know you want more of this kind of breakdown. Because I keep hearing the same line over and over again. This rally is nuts. It's stretched. It's overcooked. It can't possibly go any higher. And look, I get why people say that. When you see the major index ETFs sitting around record territory, with the broad market having just ripped higher again into the weekend, it feels wrong to believe there could still be more left in the tank. Based on the latest market closes, the S&P tracker ended the week around the low 700s, the Nasdaq tracker closed in the mid 640s, and the small cap tracker finished up in the upper 270s. That's not sleepy action. That's buyers leaning hard on the gas. But here's the problem. If you're shocked by markets, you're probably already behind them. And if you're behind them, you start reacting instead of planning. You start forcing opinions. You start saying things like, well, it has to pull back now. Or it's gone too far, so I'm going to fade it. That's how people donate money in a trending tape. The market doesn't care what feels excessive. It cares about positioning, liquidity, earnings, and whether sellers can actually do their job. Right now, the evidence says sellers haven't done nearly enough. Now, does that mean you go all in at the highs and start swinging at everything with a pulse? No, not even close. In fact, that's the trap on the other side, because the market can be bullish and still offer terrible entries. Those are two different conversations. The trend can remain strong while your timing is awful. So I'm not here to tell you to chase green candles like a lunatic. I'm here to tell you that the cleanest setup probably isn't the heroic short. It's the higher low that scares people just enough to shake them out and pull fresh money back in. And this is where a lot of traders lose the plot. They think being cautious means being bearish. It doesn't. Sometimes being cautious just means you're waiting for a better price in an uptrend. That's very different. If the market runs straight up, your reward gets thinner. Your stop gets uglier. Your decision quality gets worse. So you don't need to become negative. You just need to become patient. Look at the structure across the big three. Large caps, tech, and small caps all pushed into fresh high ground or very near it. That matters. It means this isn't one lonely corner of the market trying to drag the rest uphill. It also means money isn't hiding in the old bunker trades. It's moving into the places that usually matter when risk appetite is alive. Tech led. Consumer growth names participated. Semiconductors acted like they remembered who they are. Even small caps, which love to lag when the tape is fake, came alive in a much bigger way by the end of the week. That doesn't happen by accident. It usually means one of two things. Either institutions are putting money to work and forcing underexposed managers to play catch-up, or shorts got squeezed so hard that the entire tape lifted together. And to be fair, I think there's a little bit of both in here. Friday had some of that squeeze flavor to it. You could feel it. It had that look where the move gets hot early, the pain threshold gets crossed, and people who were waiting for the easy fade suddenly realize they're the fuel. But even if part of the move was a squeeze, that doesn't automatically make it fake. Sometimes a squeeze is just the market's way of clearing out stubborn disbelief. And disbelief is everywhere right now. That's actually one of the most bullish things about this move. There are still plenty of people underpositioned. Plenty of people waiting for the perfect dip that never came. Plenty of people telling themselves they'll buy once things calm down. The issue is, strong markets often don't calm down in a clean, generous way. They breathe, they wobble, they irritate, then they keep going. So the first pullback, if we get one, probably attracts buyers faster than most people think. Not because the economy suddenly became easy, not because every headline is wonderful, and definitely not because geopolitics disappeared. It didn't. Over the weekend, the Middle East story was still fluid, with traders watching shipping headlines and the broader Strait situation after peace hopes helped cool oil and weaken the dollar into Friday. That means headline risk is still real, especially for the Sunday night open. But the market's center of gravity has clearly shifted back toward earnings and leadership. That's what strong markets do. They stop staring at the fire and start pricing the next quarter. And that earnings angle matters a lot this week. Tesla is the obvious one. The company has already said its first quarter results are due on Wednesday after the close. And whether you love the name or hate it, that report matters because it sits right at the crossroads of growth, retail attention, speculative appetite, and the whole debate over whether this market still wants story stocks to lead. So yes, people are going to watch that one like hawks. And if Tesla moves big, it can spill over into discretionary tech, sentiment, maybe even the whole tape for a day or two. But it's not just Tesla. This week also brings other heavyweight reports across aerospace, chips, and industrial technology, which is important because the broader bullish case gets stronger when leadership isn't isolated in one or two names. That's one reason I'm not fully buying the lazy bubble argument here. Is the market extended? Sure. Are some names frothy? Absolutely. But there's a difference between a narrow mania and a tape where leadership has broadened, volatility has eased, and credit hasn't started screaming that something is broken. The high-yield market is still holding together pretty well, and the fear gauge finished the week down in the high teens. That's not what panic looks like. Now let me challenge one thing, because this is where I think people can get too comfortable. Just because the trend is strong does not mean every dip is automatically a gift. Some dips are gifts, some dips are warnings in disguise. The difference is depth and response. If we pull back a little and buyers step in quickly above prior breakout zones, that's classic trend behavior. That's what you want. But if we start losing those obvious support shelves, and the bounce attempts come in weak, and financials roll over while rates and the dollar both lift, then the market may need more time than the bulls want to admit. That's the main near-term risk I'm watching. Not some abstract social media comment about the rally being crazy. I'm watching the stuff that can actually create friction. The dollar has been sitting near multi-week lows, just under the 98 area. Treasury yields have stayed elevated enough that the Fed conversation still matters. And even though traders broadly expect the central bank to hold steady at the next meeting, that doesn't mean the market is immune to rate sensitivity. If yields pop, if the dollar catches a bounce, if financials fail to confirm, then you can absolutely get a messy pullback even inside a bigger uptrend. So what do I do with that? I keep it simple. I do not chase extension. I do not force shorts in a market that keeps refusing to break. And I do not confuse a possible pullback with the end of the move. The game here is not to prove you're smarter than the tape. The game is to find the next area where risk becomes manageable again. That's especially true in the leaders. The strongest names are often the worst chases. That sounds backward, but it's true. When a stock or index has gone nearly vertical, the story feels safest right when the entry is least attractive. That's when discipline matters. If the market gives you a pullback into prior breakout territory, a reclaimed gap zone, or a clean intraday reversal after a flush, that's your conversation. Not the emotional urge to smash buy because everything feels unstoppable. And one more thing, stop obsessing over whether every open gap has to close, every candle has to mean something dramatic, or every overbought condition has to end in disaster. Strong trends stay strong longer than people expect. Sometimes a gap that remains open is not unfinished business below. Sometimes it's a message. It's the market saying sellers had their chance and couldn't even land a punch. The longer that kind of structure remains intact, the harder it is to make the bearish case with a straight face. You can also see that in the rotation. Recent market updates showed risk-on groups doing the heavy lifting while more defensive pockets lagged, and that's exactly what you'd expect if money managers are getting more comfortable leaning back into equities. Add in calmer volatility conditions, and you get a backdrop where dips can be bought faster than usual because the environment feels safer for allocation. That doesn't guarantee straight-line upside. It just explains why pullbacks can stay frustratingly shallow. And that stock-level discipline matters even more now because leadership is broad, but it isn't uniform. Some names still look like they want higher prices after a pullback. Others already spent too much fuel getting here. The mega-cap platform names have been acting better. The chip complex has been acting better. Certain data center and software names have been acting better. But acting better is not the same thing as safe to chase. A name can be perfectly bullish and still be a lousy entry after a vertical run. That's why I'm much more interested in the ones that can either hold above a recent breakout shelf or digest sideways without giving back much. Those are the names telling you institutions are sitting on them, not flipping them. Now, could we get one more face ripper first? Sure, markets love that move. They love one more squeeze, one more push, one more candle that makes patient traders feel stupid. But that final burst, if it comes, usually makes the next setup easier, not harder, because it creates the stretch that eventually needs to cool off. So I'm not trying to catch every inch. I'm trying to catch the part where the odds start leaning my way again. And here's another fresh point that I think matters. Based on recent Wall Street reporting going into this week, the conversation is shifting deeper into earnings season, not away from it, even with all the noise overseas. That's important, because when a market chooses company reports over scary headlines, it's telling you something about appetite. It's telling you participants still want to own exposure unless the numbers or guidance force them out. That can keep the floor under the market longer than bears expect. The only thing I would not do here is pretend there's no risk. There is. If a big earnings miss lands in one of the leaders, if guidance cracks confidence, if rates reprice hard, or if geopolitical headlines hit in a way that sends oil screaming back up, then this market can absolutely wobble harder than people think. And if that happens, the strongest names from last week might become the fastest profit-taking vehicles this week. That's normal. Strong names get sold first because they have gains to harvest. So the message is not blind optimism, it's conditional optimism. Bullish until proven otherwise. Patient until price offers something better. And skeptical enough to know that a powerful rally can still hide weak hands under the surface. And if you're successful, share your success story in the comments so others can stay motivated. Because that mindset piece matters more than people realize. A lot of viewers are trying to learn when to be aggressive and when to sit on their hands. Here's the shortcut. In a strong tape, patience is not weakness. Patience is position management before the position exists. You're waiting for the market to come back into your strike zone. That's not fear, that's professionalism. So going into this week, my base case is still pretty straightforward. The trend remains up. The burden of proof is still on the sellers. Earnings are now the main engine for attention, and the highest probability opportunity is probably not buying the exact high or shorting the exact top. It's letting the market show a little exhaustion, a little digestion, maybe a little headline-driven wobble, and then asking the real question, are buyers defending a higher low or are they finally stepping aside? If it's the first one, then the path of least resistance probably stays higher. If it's the second one, then fine, we adapt. But until that actually happens, I'm not interested in talking myself into doom because the market had the nerve to stay stronger than expected. Markets do that. They embarrass certainty. They punish early victory laps. They make the obvious trade feel impossible right up until it isn't. So no, I'm not saying this market has to melt straight up from here. It may not. A pause would be healthy, a reset would be normal, a shakeout would be completely believable. But as of right now, with record area price action, easing volatility, a softer dollar into the weekend, and a calendar shifting attention toward major earnings, the setup still favors respect for the uptrend over romantic fantasies about the crash that should have happened already. So that's the plan. Stay flexible. Stay disciplined. Don't chase what already moved if the risk makes no sense. Don't fade strength just because it irritates you. Let the market come in a bit, and if buyers defend the next higher low, that may be the moment that matters most. And as always, take this for what it is. An educational market discussion from one investor to another, not personal financial advice, not a trade order, and definitely not a promise that the market will behave itself just because we made a plan.